Welcome, everyone, to today's discussion on investment options. In the complex world of today's financial landscape, the key to building wealth isn't just about earning a high salary anymore. It's about making your money work for you, and that's what we're here to explore. We're diving into the rich waters of two major asset classes, stocks and real estate, and unpacking the strategies and considerations that come with each. So strap yourself in and get ready for a deep dive into the world of investments. Let's dive right into it. We all know that investing in the stock market can be a powerful wealth-building tool. It can turn your hard-earned money into a considerable fortune. But here's the catch. It's not a get-rich-quick scheme. The stock market is about playing the long game. It's about patience, discipline, and most importantly, a sound long-term strategy. So, what does a long-term strategy look like? It's about diversifying your investments and not putting all your eggs in one basket. You can invest in individual stocks, or if you prefer a more diversified approach, you can consider index funds, mutual funds, or exchange-traded funds, also known as ETFs. Index funds are often a favorite for passive investors. They're designed to track the performance of a specific market index. The beauty of index funds lies in their simplicity and cost-effectiveness. They're passively managed, which means they have lower fees compared to other investment vehicles. But maybe you're more of an active investor. In that case, mutual funds might be the right choice for you. Mutual funds are actively managed, meaning a fund manager makes the investment decisions. This active management can lead to higher potential returns, but it also comes with higher fees. And then there are ETFs, a sort of hybrid option. ETFs can be passively or actively managed, giving you the best of both worlds. They provide the diversification of a mutual fund or index fund, but with the added flexibility of trading, like individual stocks. In the end, the choice between individual stocks, index funds, mutual funds, and ETFs depends on your investment goals, risk tolerance, and the amount of time and energy you're willing to invest in managing your portfolio. Remember, the stock market isn't a sprint, it's a marathon. It's not about timing the market, it's about time in the market. So develop a strategy, stick to it, and let the magic of compounding do its work. ETFs provide the flexibility of trading like individual stocks, and that, my friends, is a quick overview of investing in the stock market. Now let's talk about dividends in stocks. When you invest in a company's stock, you're essentially buying a piece of that company, becoming a shareholder. Some companies, as a way to share their profits, distribute dividends to their shareholders. Essentially, dividends are your share of the company's profits. Dividends are a fantastic way to generate passive income. Imagine this, you're getting paid simply for owning a piece of a company. How brilliant is that? Dividends can be a consistent stream of income, particularly attractive to those seeking stability, such as retirees. But it's not all sunshine and roses. Dividend-paying stocks have their own set of pros and cons. On the pro side, they offer a regular income, which can be especially welcome in volatile markets. On the downside, companies that pay out a significant portion of their profits as dividends might have less to reinvest in their own growth. So, you may miss out on potential price appreciation of the stock. Another key point to consider when it comes to dividends is their tax implications. Dividends are considered income and therefore are subject to taxes. However, the silver lining here is that qualified dividends are typically taxed at a lower rate than your regular income. In short, dividends are a great way to earn passive income and can be a valuable part of your overall investment strategy. But, as with all investments, they come with their own risks and benefits. Dividend income is typically taxed at a lower rate than regular income. Now, how do you approach your investments? It's all about having the right strategy, one that aligns with your unique financial goals and risk tolerance. Let's break it down into two main investment strategies, passive and active. Passive investing is like planting a tree and letting nature take its course. You consistently invest in funds, such as index funds or exchange-traded funds, and let compound interest work its magic over time. This strategy is less about timing the market and more about time in the market. It's a low-stress, long-term approach that's perfect for those who prefer a hands-off investment style. On the flip side, we have active investing. This strategy is more akin to being a gardener, carefully tending to your investments. Active investors may choose individual stocks, buy and sell based on market trends, and seek to outperform the market. It requires more involvement and knowledge, but can potentially yield higher returns. Remember, there's no one-size-fits-all strategy. You might lean more towards passive investing, active investing, or a blend of both. It all depends on your financial goals, risk tolerance, and personal preferences. The key is to set up an investment system that aligns with your financial goals. Whether you're investing in stocks or real estate, having a clear strategy will guide your decisions and keep you on track towards financial success. Let's shift our focus to real estate, a tangible asset that you can see, touch, and even live in. As an investment option, real estate has its own unique set of benefits that can make it an attractive addition to your portfolio. When we talk about investing in real estate, we're not just talking about buying a family home. We're talking about investment properties, rental properties, commercial properties, and even vacant land. And just like stocks, each type of real estate investment has its own set of pros and cons. One of the biggest advantages of investing in real estate is the potential for cash flow. This is the net income from a real estate investment after mortgage payments and operating expenses have been made. A positive cash flow means you're generating a return on your investment, and this can provide a steady stream of income that's often more stable and predictable than stock dividends. However, it's crucial to calculate this cash flow accurately and maintain a financial cushion. You see, unlike stocks, real estate has ongoing costs, such as property taxes, insurance, and maintenance. Not to mention, there can be periods of vacancy where no rental income is coming in, so it's important to have a buffer to protect yourself against these potential economic downturns. Now let's talk about leverage. In real estate, leverage is using borrowed money to increase the potential return of an investment. In other words, you don't need to pay the full amount up front. You can buy a property with a small down payment and borrow the rest. This means you can own a substantial asset and enjoy its full capital appreciation while only putting down a fraction of its total cost. But be careful not to over-leverage. While it can amplify your profits, it can also amplify your losses. If property values decrease, or if you struggle to meet your loan repayments, you could be in a sticky situation. It's always wise to borrow within your means and have a solid exit strategy in place. And here's a tip. Consider hiring a property management company. They can handle the day-to-day operations of your property, such as collecting rent, dealing with repairs, and responding to tenant complaints. This can reduce the stress of direct property management and free up your time to focus on finding your next investment opportunity. So, there you have it. Real estate can be a lucrative investment option, offering the potential for cash flow, capital appreciation, and leverage. But like all investments, it comes with its own risks and challenges. It's important to do your due diligence, crunch the numbers, and always have a plan. Hire a property management company to reduce the stress of direct property management. And remember, whether you invest in stocks, real estate, or both, the key is to make informed decisions based on your financial goals and risk tolerance. Because at the end of the day, it's not about making the most money, but about building a sustainable and diversified wealth portfolio. In conclusion, when it comes to building wealth, it's not about choosing one over the other. The world of investment is rich and diverse, offering a plethora of opportunities. The key lies in diversification and astute consideration of your options. Stocks and real estate each provides unique benefits. It's about finding a balance that suits your financial goals and risk tolerance. Stay tuned for more financial insights, and remember, the journey to financial success is about making informed choices and taking a long-term view. Thank you for joining us today. Your journey to financial success is a marathon, not a sprint. If you appreciated our dive into stocks and real estate, show some love with a like and subscribe for more insightful discussions. Got something on your mind? We'd love to hear your thoughts and questions in the comments. Keep an eye out for our next episode, where we'll explore more ways to make your money work for you. We'll see you in the next episode.